We also have Vinod Karki, who's waiting by very patiently. He's the head of strategy at ICICI Securities. Very sorry, apologies for that, actually, Vinod, for keeping you waiting for so long. But yes, this particular news development coming in, not too positive for Vodafone Idea or the telecom space as a whole. Firstly, let me start asking you, do you have a view on the telecom space?
Well, overall, telecom sector is coming out of a lot of pain, which has been there. Initially, there was a lot of competitive intensity, followed by regulatory issues, then the court orders and things like that. And finally, I think the sector as such is seeing for the first time after a long time tariffs going up. So that's good overall. I mean, the cash flows are going to improve and profits are going to rise, and they'll be able to invest, which was not happening because tariffs were not rising. So I think overall the sector is good. Individual stocks will have their own stories to play out. I'll not be commenting on individual stocks, but the sector as such is on a repair and it's improving.
Yes, absolutely. Looks like that at this point in time. I'll not put you in a spot by asking you about any of the stock specific details, but let's talk about what's exactly happening in the defensive sector. Because if you look at the defensive sector, the valuations are near the 2-decade high. What would that actually signal? Are you likely to see or a potential correction coming in, given the fact the valuations are pretty much steep for the defensive space?
Yeah. So see, if you look back in history, so this will play out in the way the market and the economy progresses. So what I mean by that is, if you look at the period just before the global financial crisis, the investment rate, all the industrials, capital goods, and the utilities, and all the balance sheet-driven companies, they saw a wonderful time in terms of growth. Picking up significantly, real estate and all, accompanied with these industrials and the corporate banks. So what happened essentially was that the investors flocked to these growth assets, which was growing very fast, faster than the economy. Because of this tilt towards these sectors, which traditionally are value, but they were growing very fast. They turned out to be growth companies. And during that time, the defenses, which traditionally you will see, I mean, across cycles, the very name defenses means that their growth is not volatile. So, in the sense that when you have a big upcycle in the economy, they will still be, they won't participate in terms of high growth, basically. And when the economy is in a downturn, they will not participate in the downturn itself. So they will remain fairly resilient overall. But when an economic upcycle comes, the relative growth of cyclicals tends to be much higher. And currently, we are seeing some growth concerns also from the defensive sides. I mean, not only are the cyclicals growing faster, we have growth concerns on, let's say, IT sector. We have seen the growth concerns and a lot of concerns on agri-rural economy. This year, we had a massive heat wave, and now a lot of rainfall, temporal and spatial distribution has been pretty, pretty uneven. So the outlook is not looking that good from, so consumption and, so IT services and consumption are seeing some kind of growth issues overall. While, as I said, we report in our analysis, the valuation seems to be at a record high. So I think there is this possibility that even though the cyclicals are pretty expensive, there might be some shift there.
Okay, you are mentioning that cyclicals are seeing strong growth, but they are still expensive. But you could still point out few pockets that could re-rate further. Which are these pockets, and what could be the factors that could lead to this re-rating?
Absolutely. So the only 2-3 sectors where, see, overall we are at a bull market valuation. So market cap to GDP, any metric you take, price to book, we are at bull market valuations. Only pockets where the valuations are moderate and close to average or even below average is in banks, large financials. There is no sign of a bull market valuation currently. Similarly, some of the the commodity companies on a price to book basis, because you can't look at P in these companies. Price to book is a key. They are high, but they are not reached like the rest of the market is completely at all-time high valuation. So broadly, if you look at the valuation perspective, it's the financials, energy, utilities. Utilities, although is rising, but still not at extremely high this thing. But these are some of the pockets where I think valuations are still not reached bull market peak valuation. They're not extremely cheap, but like the rest of the market, they're still not at the peak end of the valuation band.
Okay. You also mentioned that private capex has to pick up significantly for the bull market to continue going forward.
Absolutely.
So, but we are not still seeing any significant signs of pickup when it comes to private capex. So, what is it that you're understanding and making, and what is it that is making you so confident that yes, private capex will pick up?
So, a couple of things there. One is the narrative. So when you say private capex is not picking up, you look at the actual cash spent on capex by these companies, which flows to their financial statements. But that's not yet picked up significantly, although it has significantly bottomed out and is nudging up. There is absolutely no doubt about it. Only that the growth is not significant, but it's clearly bottomed out. But in terms of the announcements, the narratives of envisaged capex going ahead in the next 2-3 years, the things it looks very very promising. Most of the large industrial houses, if you even check their narratives, everyone is lining up big capex plans. But as you rightly pointed out, it will show up in the statements of these companies in terms of actual cash spent on capex only with a lag. So that's the thing. And in general, the India Inc. currently is doing just about maintenance capex. So that's another indicator that while the narrative is strong, the GDP is going into 7% plus growth rate. To participate in this growth, the companies will need to do investments, which they are talking about, but it's not showing up in numbers yet. So these are some of the factors which makes us very clear. More confident that we are at the bottom of the capex cycle. The NPA cycle is at the bottom, so it will be quite a few years before that starts picking up on the corporate side. Industry credit is just about picking. So no overheating over there. And cyclically, the GDP, we have seen revisions upwards. So corporates will participate in this growth rate for sure. And for that, they'll need to invest.
Right. And for that, actually, Vinod, that leads me to the next question. One of the key reasons also would be what happens in the interest rate scenario for actually corporates to go ahead and participate in this CAPEX cycle, isn't it? You have the Federal Reserve that has gone ahead with a big, massive 50 basis point rate cut. What's your view coming in on the Indian markets if and when we will have the MPC moving on in that direction?
So if I go by empirical evidence, interest rates necessarily low. I mean, for starters, low interest rate is helpful, but we saw in the previous cycle also between 2003 and 2008. So at the starting point, the interest rates were low, but as the capex cycle progressed, in fact, interest rates started to rise and rose to cycle highs. So I think we are coming off a very low interest rate environment. Rates have picked up. I mean, what happened was in 2022, there was this inflation spike globally. And country like US saw 9% inflation. So currently what you've seen in the US itself, the rate cut, the massive rate cut, 50 bips actually is misleading in the sense that the ultra high interest rates in the US, I mean, they cannot sustain 5.5% kind of interest rates. So if you look at the dot plot, the trajectory, what is coming out is that, and the bond market itself is showing that 3.5-4% will be the kind of interest rates in the US over the next several years. which I feel is quite high, coming off ultra low interest rates in the in economies like US. So I think the interest rate moderation, I may call it, not interest rate cut cycle, severe rate cut cycle, which effectively, if you have a very fast interest rate cut cycle, it effectively means there's some kind of problem with growth, and then Capex eventually will fade. So signal should be that you should have robust demand, which will allow people to forecast interest rates a little higher. So there will be some moderation in interest rate, but I don't think a very sharp cut in interest rates are possible.
Well, thank you, sir, for joining us and for giving us those details and for putting things into perspective.
If you like this video, then like, share and subscribe to ET Now.